Got it. Just told me you're recording. Okay. So these are the topics I'm going to cover: fertilizer price outlook, fuels and chemicals, machinery, interest rates, and land values and rents are all going to be part of it. I want to kick it off though with what the title implied, which was fertilizer prices. And a report from the World Bank that actually just came out like yesterday or the day before was discussing the global fertilizer situation right now. And that's important. It's important to kind of pay attention to what's going on globally with fertilizer because it is a globally traded commodity anymore. You know, that didn't used to be the case. And I was talking about this topic a week ago in Devil's Lake. And when I did some research on anhydrous ammonia production and nitrogen fertilizer back in 2013 or so, and 12. And one of the things that used to be true was you used to be able to benchmark the price of nitrogen fertilizer, basically anhydrous, and then everything else it starts as anhydrous and then they synthesize it down later on down the road. But you used to be able to benchmark fertilizer prices by the price of natural gas, right? It used to be as if natural gas prices went up, then fertilizer prices would go up, and there's a pretty tight correlation between the two. And when they went down, they'd go down. Well, that all fell apart during the big corn ethanol boom, EISA mandate back in 06, 07, 08. And all of a sudden, it started moving mostly independent of natural gas prices. Now, natural gas prices absolutely matter. And as they went skyrocketed, that does have an impact on fertilizer because about 83 to 85% of the cost of nitrogen production comes from the cost of natural gas. But we also saw instances where fertilizer or natural gas prices were way down and fertilizer prices didn't come off. And part of that is because the U.S., if fertilizer prices are low in the U.S. or going down, then they'll just sell it abroad and export it. And then if prices get too high in the U.S., we import. But that said, so talking about this report that came out, 70% of ammonia production capacity was halted in Europe due to high natural gas prices. I think you guys probably heard a bit about that natural gas prices got so high in Europe. There was big concern about heating costs. And so a lot of the ammonia production plants were basically suspended or shuttered for a while because of the concern of supply of natural gas and then the impending costs. Now, some prices have eased back a little bit on natural gas, that is. So the thought is a lot of these plants may come back online or start increasing capacity. But that's going to still have that high world price of ammonia heading into the spring, or at least keeping the levels higher because it's going to take some time before those come back online and get to really ramping up production. And then, though the conflict with Russia and Ukraine resulted in sanctions, Russia was given a carve out to continue exporting fertilizer. And I'll show a chart in a minute, but Belarus reduced potash exports by 50%. And I got some charts that are going to show what happened with potash prices because of it. And that matters a lot because Belarus is a big exporter of potash. And so let's look at the share of global exports by Belarus, Ukraine, and Russia for urea, DAP, MOP, which is muriate of potash, ammonia, and sulfur. And if you look at urea, you know, Ukraine puts out a not insignificant exports about 5% of the world's urea. And then Russia exports almost 50% of the world's urea. So that's actually quite a lot that is being put out there, but those countries, that's what they're responsible for. But look how much ammonia on the world market that Russia exports, over 30%. So interruptions in that, and you can see why it drove up, and then concerns about it drove up the prices of these fertilizer products because Russia especially is a major player in ammonia and DAP and urea and sulfur as well. And then here's the deal with China too, who's a major fertilizer exporter. China extended its export restriction on phosphorus and other things all the way to the end of last year. It was supposed to go through last summer. If you remember, I'd given some fertilizer talks that they were suspending phosphorus exports until at least June, July of last summer. And then that got extended through the end of last year. Now, China exports 30% of the world's diammonium phosphate, and that fell by 50%. And then urea exports declined by 60% last year. And you can see it through here. The red line, 19 to 21, is how many millions of metric tons they typically export, China, that is. And then the red line is what they did in 2022, right? So on the global market, that's a big hit between the goings on between Russia and Ukraine, and then China's moratorium on exports, and what happened on global markets. So you can see that's going to make a big. Now, the U.S. didn't have any problems securing the products. We make most of the anhydrous ammonia that we need for our nitrogen fertilizers, and pretty much all of the phosphorus too, most to nearly all. We do export almost all the potash we use, but we get most of that from Canada. All right, like 75% of it. The problem is, like I said, though, we still have to pay world prices. I mean, a lot of these companies are global companies, even though they're based in the U.S. And so if you can get $1,400, $1,300, $1,200 a ton for anhydrous, selling it to South America, then that forces the U.S. producers and co-ops to pay the same world price, right? So that's some of what happened in the last year with that. So let's get into the specifics on U.S. fertilizer, okay? And the chart on the left is the cost per pound of nitrogen for various fertilizer products. The green line is anhydrous, the red is urea, orange is UAN 28, and the blue is 32. And it peaked, the nitrogen cost per pound of these fertilizer products peaked around February, March of last year, 2022. And they've come off some, especially urea. That one's declined considerably since then. March of 22, it was around $1.10 a pound per pound of N, and now it's down below 90 cents. And then if we look at DAP price here, which I put on this one, it peaked around $1,040 per ton around that April timeframe. It's come off around 15 to 20%. But still, if you look at these charts, so let me back up real quick. I have several of these charts that are on the right, the one that looks like it's on the right. The gray dotted line is the 5-year average. So for those in the back who can't read it, the gray dotted line, read what it says. The gray dotted line is the 5-year average. The red line is 2022, and the green line is 2021. So red is last year, green is the year before that, and the gray dotted line is the 5-year average. And so you can see how high DAP was above the 5-year average starting last spring. It was more than double, and it still remains elevated. It's just down 20% from kind of the all-time high heading into this next year. Urea prices, okay, that spiked also in March. Urea nationally was up over $1,000 a ton come March of last year. Now it's dropped since off the high about 25% down to about $750 a ton. Okay, but again, that 5-year average, for the most part, it's been around $400 a ton for urea. So at $750 a ton, it's not quite double what the 5-year average is, but still significantly higher, almost double. But we were approaching more than double, 1.5 times or 2.5 times spring of last year. So relief on the urea front compared to a year ago, but still greatly elevated. And then starter fertilizer, 1034.0, big drop in that in October as nitrogen prices came down some, and it's been maintaining about $750 a ton. That 5-year average on 1034.0 about $475 a ton typically. Okay, so 5-year average about 475. Right now, about 750. So again, another product that the cost has stayed pretty high. I already showed you the DAP price on the other slide, but MAP prices as well. MAP's a just slightly higher than DAP. They trade in the same essential range. So that again, that's around $850 dollars a ton as well, the same as DAP. And then I didn't have the slide on here, the chart, but potash is about double, and it hasn't come down a lot. It's about double the typical price, double to triple as well. And for reasons I showed before with Belarus's export halts. So state fertilizer prices versus the national average. I can't pull North Dakota because we haven't done enough business as a state yet to actually have any meaningful statistics through DTN who tracks this stuff. But like Minnesota anhydrous was last week or month or so about $1,400 a ton. Nebraska's anhydrous $1,300. Urea in Minnesota $850. Nebraska $740. And South Dakota about $700 a ton. That's what. So I pulled the closest states I could that had data to show kind of in this northern plains corridor. Yeah, that's about what we're seeing for those costs. And then, like I said, potash, South Dakota about $700 a ton, Nebraska $775, and starters in the $750. So as we head into this next year, and folks are making planning decisions, after the last year we had, I don't think there's going to be as much sticker shock with the high price of fertilizer, especially considering that most of the products have come down, but nowhere near the 5-year average. There was people last spring asking me, especially co-op operators. The big concern was they were going to buy all this urea or other products for $1,000 a ton, and then the prices promptly fall to $600, which would be more than enough to bankrupt some of the smaller co-ops if you've spent that much money and then now you can't sell it, but for 40% or 60% of what you bought it for. Would have been a disaster, a financial disaster. Well, that didn't happen, and they have come off, but most of the decline has kind of been. Last year we weren't sure, with China's shutting down of factories and export moratoriums, and then the conflict in Russia escalating, and then all these other things going on, plant shutdowns. Was there going to be enough fertilizer even to go around? Were there going to be shortages all over the place? So that kind of baked in a risk premium in these costs. Well, a lot of that's subsided, but some of the fundamentals that caused fertilizer prices to be high, they remain. And the other thing that kind of has gotten thrown into it a little bit was there was some drought on the Mississippi River corridor last summer and into this fall, which has caused some problems with barge traffic. Getting up the Mississippi from New Orleans with these barges that brings product up the Missouri River into the northern plains. In fact, they were going as far as dredging out parts of the Mississippi River to be able to get barges through because the water levels were down far enough that they had to. And that's something that my brother deals with. He's a fertilizer trader in Nebraska, and acquiring barges and how much it costs and finding times to get them upriver when they're sitting there dredging the thing out. That's a problem. So by and large, I don't see a big decline from where we're at right now in the price of fertilizer heading into this next spring. Unless all of a sudden the conflict in Russia and Ukraine gets worked out, but even if it did and there was some kind of ceasefire and agreement took place, it's probably going to take some time to get all that worked out and everything back on schedule. Then how long is China going to continue restricting exports as they're concerned? And then natural gas prices, they've been high. Are they going to continue downward, which may soften the fertilizer market too? And the other thing to remember, a lot of the fertilizer production went away from creating slack in the system to basically as close to a just-in-time production as they could get. And so it's not like they're going to crank out a surplus anytime soon that would force prices down. So real quick, any questions regarding fertilizer as we move on to the next topic? Hearing none, then I'll just finish off with this. As far as fertilizer goes, we've got some resources at NDSU, fertilizer recommendations that are put out by Dave Franzen, one of our soil scientists, who kind of talks about the price of different crops, namely like corn and wheat, and recommended fertilizer applications rates and those kind of things. Here's the website. Nobody's ever going to remember that, so my best suggestion is just Google search North Dakota State University Extension fertilizer and it'll come up. We used to link the websites, but nobody's going to remember all that stuff, so Google will find it. All right, next topic, some of the chemicals and machinery costs. So last year, diesel prices for off-road diesel were, at some of the highest highs ever seen. Almost $5 a gallon. I pulled these from Jamestown for their off-road diesel sale. There's nothing, I don't have any information closer to Divide County than that, but it was probably pretty similar because it is like in Grand Forks, Fargo. Diesel, this right now, as of yesterday, had come down to $2 and about 99 cents a gallon as compared to $4.75 last spring. So a considerable reduction in diesel prices, almost $1.75, but still quite a bit higher than where we were in like June of 21, when diesel costs were closer to about $2 a gallon. Okay, so about $1 higher than that. So off the highs considerably. But when we compare it to 2021, which was more of an average production cost year, we're still about $1 a gallon or 50% higher than that heading into this year. And probably not going to see a big increase or decrease in that moving forward. Ag chemicals, this would be your general herbicides, pesticides, fungicides, those kind of things. You can see what's happened with ag chemicals, and they ran up with fertilizer because a lot of the plants, the same plants that produce in China, not that produce fertilizer, but a lot of the components that go into the production of things like glufosinate and glyphosate are in China. Things like yellow phosphorus, for instance. And those plants all shut down. And then we had the supply chain problems and the being able to source that stuff. So ag chemical, the index for ag chemicals just skyrocketed beginning in 2021, along with all of our other production costs. And the way to read this index, they just take a benchmark year and it's more or less in percentages. So in January of 2021, the index was about 220. January of 2023, the index is about 380. So if you divide that out, you can get the percentage increase in overall chemical costs in the last year or so. Spiked last spring, there's been a bit of a reduction, but by and large, most chemical costs, so what we're looking at for glyphosate, glufosinate, all the other products that we put on, probably going to be down a little bit from a year ago, but not remarkably. Okay, off the peak, but only just off the peak. And the other thing to recall, remember last year we were concerned about even being able to get chemicals. Was there going to be a shortage? Again, kind of like the fertilizer price acquisition issue. Turns out we were able to acquire them, and I think the same is going to be true this year, that you'll be able to get what you need, but they're not going to be remarkably cheaper than they were a year ago on the chemical side. Long distance trucking and freight, those costs, I put those in there, especially if you're doing a lot of hauling or contracting that to be done. Down some, and most of that's coming from a bit of a reduction in diesel fuel prices. Okay, so labor costs are up, so paying for trucks, truck drivers, that's increased. I'll talk about repairs and equipment in a minute, but that's up as well. So the reduction in shipping costs and freight, most of that's just come from the diesel prices being off the highs that they saw last spring, or that we kind of witnessed last spring. How about farm machinery? Here is machinery and equipment, okay? This is what's happened. What we call this right here, where you have this elbow, where you got the trend, and you see this equipment price trend had just been tracking along at a fairly steady clip, a few percent a year. Then all of a sudden, spring of 2021, we call this a kink point, where the slope of the line dramatically changed and starts going upwards, all right? So we started the year 2021 at an index of about 240, just above it, and then over 310, 320. So about 40% increase in equipment costs is roughly what that's showing. Okay. And this is the last time we saw kind of an increase that even remotely resembled that. It was brief, and that was the tariff that was put on steel and aluminum. When we put a 25% tariff on those back in 2018, you see this little increase right there. That's what that did. This, on the other hand, has shot up and stayed up and is pretty unprecedented, actually, the cost in new equipment and used equipment for that matter. Big reason for that, I'm sure most of you guys have heard about it or dealt with it or are dealing with it. Shortages on things like printed circuit chips, ability to secure things like discs and the components that go into your like planning equipment. You know, I'd heard about dealers being only able to get so many replacement discs and stuff for the planners. Like they were only going to be given so many, and that's it for the year. So if they ran out and doled out too many to producers, well, it was kind of tough luck. I don't know, anybody in here heard of some of that going on where they were only going to get so many replacement parts and that was it for the year? Not so much. Well, it did have the other thing, and maybe some of you are dealing with that too. If you did buy a new piece of equipment, say this fall, delivery might not be till next summer, right? You might not be able to take possession till next summer. I dealt with quite a bit of that in the Valley, where a guy goes and buys a new combine and he's not going to be able to get it until next July. And what do you think that did to the price of used equipment? Because if you need one now and you can't get a new one, you got to buy used, and that drives the price up of used equipment as well. All right, now here's the equipment parts. Same thing. Big increase in replacement parts too, right? So new equipment, prices shot up. Replacement parts for new equipment or used equipment, those shot up as well, same time frame. Big increase in those, going up almost at the same rate as new equipment. And then attachments, the price for machinery attachments, your pull type attachments, those kind of things, same story. So pretty much across the board, as far as equipment goes, whether it's the attachments, the replacement parts, new equipment. I don't have a chart on used equipment, but take my word for it, it's similar to new equipment, just have gone up pretty remarkably. And, you know, here's the question I've gotten. Do we think that these prices are going to come down? Because along with all the other issues that have been going on in ag and the availability of products and the cost of products and manufacturing, we've had inflation in the rest of the economy too. And one thing I haven't really ever seen very much, you go back and look at the data, is new equipment prices declining. Just because inflation stops doesn't mean prices go down. It just means they stop increasing at a high rate. I do expect that used equipment prices will come down and in some cases already have, and they have before. Like in 2013, when new equipment costs were really high, 2012, used equipment prices a couple of years later actually did come down. There was a correction in used equipment prices, not so much in the new equipment side. So I don't foresee a reason. And the other thing is, John Deere, for most of these equipment manufacturers, do a just-in-time production process. They don't just build out a fleet of inventory and then hope that they're able to sell it all. A lot of it's a just-in-time based on requirements and requests for producing new equipment. So they're not going to flood the market with new equipment that's going to drive prices down as dealers try to liquidate their lots. Probably not going to happen. So I don't see a reason in the coming years that new equipment prices are going to decline dramatically. They probably won't. So that's something we're going to have to get used to, are these high new equipment costs. But I do think used will come down some. So next topic, land values and rents. I always like to hit on these because they are a production cost. This map is put out by the USDA, and it's they do one every year, and it has to do with production, the cash rents and land values around the U.S. and their national averages. North Dakota was up about 14% from 21 to 22, and Montana closer to you guys' part of the country, up about 10.5%. Okay, not records or the highest of any state by any stretch. Kansas was, for instance, up 25%, Nebraska 21%, and Iowa up almost 20%. But North Dakota up 14.1%, which was a significant jump and the largest since I've been here working at North Dakota State University. And then pasture land prices jumped as well. North Dakota saw a nearly 11% increase in pasture land prices, as did Montana, 10.7% there too. So big jump in both crop and pasture land prices. The interesting part on the pasture land was we were coming off of, the drought of 21, so 21 into 22. And I think a lot of what happened with pasture land prices, because we know commodity prices have been elevated for a year and a half or so, livestock prices have been good, but they haven't been records by any stretch of the imagination. So a lot of times what happens with cropland prices drags pasture land with it, right? So if you get cropland prices up significantly like we did, 14%, it drags pasture land with it. Now, one thing that's pretty interesting, and this is talking about the land prices, that is, 2014, 13 to 14 was the highest livestock prices ever in terms of calf prices. $3 a pound, bred heifers selling for $2,500. You remember that back in 2014 when there was the big liquidation in 12 and went into that. And pasture land prices jumped 10.3% nationally. Last year, they jumped 11.5% nationally, and livestock prices weren't anywhere near as good as they were in 2013 to 14 to 15, right? So it's interesting that we had the highest since actually the last 25 years, the highest jump in pasture land prices, despite the fact of not having that strong of livestock prices. They were good, but they weren't records by any stretch. Now let's talk about the crop side. We all remember how good commodity prices were in 2012 and 13, right? 2012 was one of the single greatest years in North Dakota history in terms of net farm incomes. And commodity prices were strong around the country too, not just here, obviously. 13.7% jump in land prices between 12 and 13. Last year, which was not as good as 2012 to 13 by any stretch, 14.2% nationally, okay? So percentage-wise, we had one of the biggest jumps in land prices of all time in 1 year. And yet, commodity prices were pretty good last year, but production costs were pretty high too. So margins were all right, but they weren't record-setting by any stretch. So it's pretty interesting that we see this big jump in land prices despite revenues not being as strong as they had been in the past, right? So something has to explain why land prices shot up as much as they did without the revenues being there actually supporting such a jump, right? And my theory on talking about it with others has been that because of the two reasons really. Because of the way that MFP 1, 2, and CFAP was paid out in cash, right? And you combine that with extremely low interest rates at the time this all took place, actually propelled land prices up higher than they would have ordinarily been had there been just more typical years without those ad hoc programs being added to it. That there was folks sitting on pretty large piles of cash, and that was then converted into a land purchase and doing it around the country. And then couple that with extremely low interest rates, that folks aren't afraid to finance anything because interest rates were negligible, led to some of that actually happening. Now, cash rents, for the most part, they've been flat for, really about 8 years, 7-8 years. And we've seen a little bit of upward movement. So if you look at the chart, I mean, they are higher in 2022, for instance, than they were in 2014, but not a lot, not compared to what land values have done. And reconciling that, or squaring that circle, as some folks like to say, I think a lot of that came from when we went into the beginning of next year or last year. We came off a strong commodity price year, but we were looking at these high production costs, right? And in talking with landlords and potential tenants last spring, there was a big concern on what the market was going to do. And then going into the year with these high production costs, folks were reluctant to pay a higher rent or ask for more rent because they were, you're staring down the barrel of $1,000 a ton urea. Even though corn and soybean and wheat prices were good, you didn't want to necessarily ask for a whole bunch more money because the equipment costs were going up. So it didn't. Land prices did, on the other hand, because that's more of a long-term investment. Cash rents have to cash flow in the year that you do it. You don't get to make it up on equity down the line or some kind of increase in land prices. But here's the thing that happened with that. Well, actually, I'm going to get to that in a minute. We'll talk about interest rates before I go into that. It'll make more sense. And I put this, here's a table essentially showing all the regions in North Dakota. So rather than showing the map, here we are in the Northwest. This is average toward the end of last year, about $35 an acre. That was the average cash rent. The rent change pretty much zero, almost a 0%, but about a 12% increase in the Northwest in land prices from 21 to 22. I don't think there's going to be as big now. The land price increase may be higher in some regions in North Dakota than others. A lot of it also depends because maybe there's not a ton of data points, right? So any year over year change, you got to be a little bit careful in saying, oh, well, the whole region actually increased 12%. Well, it depends on what sold too. I like to more or less look at trends, but when you're looking at this and these numbers are so high, it's easy to explain why we saw that yes, across the state, we saw that 14% increase. I do find it a bit interesting though, the most expensive land in the state, which is the South Valley and the North Valley, we're only in the single digits, the mid single digits in land prices, and didn't actually increase as much as others. So now going into the land price and the last thing, interest rates. The Federal Reserve's taken a pretty hawkish tone towards slowing inflation, okay? And the neutral federal funds rate is believed to be about 2.5%. So starting in 2022, here is what the Fed did last year. A quarter-point increase in March, and then a quarter point increase in March to 0.5% increase in May, June 0.75%, July 0.75%, September 0.75%, November 0.75%, December 0.5%, and right now it sits at 4.5% for the federal funds rate. That's as of right now. And then currently, 78% of the market expects that the next Fed increase will be 0.25%, putting it at 4.75% in February. Okay, with 22% expecting a 5% increase. So the deal is they're going to increase it, and tomorrow's report on inflation is going to determine which one of those probably turns out to be true. And when we're looking at interest rates right now, I know they look a lot higher, and they are more than where they've been. But the average federal funds rate since 1954 is 4.6%. Right now we're sitting at 4.5. So when folks say, oh, interest rates are high, markets say, oh, interest rates are high, they're really not actually. They're closer to average right now, going back to the 50s, all the way back. And that's actually considered, so the neutral rate's 2.5%, and the average is 4.6%. And what's that done to other interest rates? Well, when we look at the 30-year mortgage, the high was 7% this year. It's down around to 6.42%. And when I was looking at some loans kind of projected on what FSA is going to offer for operating lines as a benchmark, around 5.5% at the moment is kind of what I saw a week ago. I wouldn't be surprised if we see, about 5.5%, 5.75% on most operating loans heading into the next year, especially if we get that February 0.25% increase. But anyone, I asked this question, it's kind of, I don't expect an answer necessarily, but anyone have any idea what the average 30-year mortgage rate is since the 50s? What you think about it, get an answer in your mind. Just under 8%. So it's all about perspective, right? When you get used to operating at interest rates like over here on the left, between 2 and 4% for the last 8 years, and then all of a sudden we hike it to 7.5%, but folks have made all these business decisions as if 2 to 4% is going to be the norm forever. It does take a recalibration, so to speak, to get used to operating at 7.5 or 8%, right? And that's kind of what's happening. It's not that they're historically high by any stretch. It's just that they're higher than they have been 2-3 years ago, and that they were that low for that long that folks just got used to it. All right. So this was put together by USDA, and it's just a chart, and I know it's hard to read, especially if you're in the back. But you've got corn, soybeans, wheat, oats, and barley. I just picked some crops to kind of illustrate what the expectation for production costs are. The ones I highlighted in red are costs that are expected to be higher next year. So for things like corn, seed costs higher, soybeans, seed costs higher, wheat, seed costs higher compared to 2022. The ones that are highlighted in yellow are expected to be less compared to a year ago. So we already talked about fertilizer, a bit less for corn, soybeans, wheat, oats, barley. Chemicals, same story. Custom hire, a little bit more expensive. Fuel, lube, and electricity, those prices down a bit. Repairs up. We talked about machinery, parts, so that you had the specifics there. And then interest up pretty much close to double what was paid last year. You kind of expect that your interest bill is going to be at least twice what it was. And that shouldn't be a super surprise because we went from 2.5% to nearly 7.5% in a year. So it stands that math is pretty easy to do. Some of the overhead costs on most of these crops, and it's pretty much true across the board. The things like chemicals, fertilizer, etc., opportunity costs of land rental that's expected to be about the same. I think it's going to go up, and then general overhead up as well. But in total, what that essentially shows, a slight reduction when you take all those costs into consideration. The expectation is that this year, overall, when you include interest, fuel and lube, energy, equipment costs, chemicals, etc., overall production costs down slightly from last year. Not a lot, not a massive decrease. In some cases, just single percentage points, but down nonetheless. Compared to a year ago. And again, a large part, fertilizer prices coming down and fuels coming down. Now, I do want to say something about the land deal because I want to make sure I had it at the end enough time. Anybody who tracks farmland or thinks about if you're a banker or an appraiser or those kind of things, we throw around this word called cap rate. Okay. And the cap rate essentially is you take the cash rental rate of a piece of land, you divide it by the market price, and that gives you a percentage, and they call it the cap rate. And what that reflects is the income that piece of land is expected to bring in relative to the market price. So if the land is $10,000 an acre and it generates a cash rental rate of $500 an acre, I'm just making that up to make the math easy. That's cap rate of 5%, right? Pretty easy to compute. The cap rate in North Dakota has typically been between 2.5% and 3% for 8 years. I mean, somewhere bounded between 2.5% and 3% for about 8 years. Well, farmland prices in North Dakota went up 14%, and rents went up about 3%. So that actually made the cap rate shrink even more. And I haven't run that here the most recently, but it's going to be probably below 2.5%. But the interest rates have been around 2.5%, 3.5% for the last 8 years also. And if you go back and look at that cap rate on farmland since the 80s, typically the cap rate on farmland is about a percentage point below what the prevailing interest rate is. So if the interest rate's 4%, the cap rate's usually about 3%. If the interest rate's 9%, the cap rate's about 8%. And that's what it was in the early 90s. That cap rate, cash rent compared to market price was about 8%. As interest rates declined, that cap rate declined. So here we sit with an interest rate approaching 7.5% to 8%, but a cap rate of 2.5%. 2 to 2.5%. So that begs the question, is the cap rate relationship going to go back or maintain that 1.5 percentage point below what the prevailing interest rate is? Now, one of two things has to happen to get that cap rate more in line with to keep that relationship as strong as it's been. You can either A, basically triple cash rents, or B, cut land values by about 60%. I mean, because it's a ratio, right? I mean, it's pretty straightforward. I'm not going to speculate on which one of those will happen, if indeed any of them will happen. And then the final one is you hold land values constant and cash rents increase at 10 to 15% per year for a while until it catches up, which is probably the most likely scenario if that relationship is strong enough to hold things together. And I'm not trying to say either one of those two things are going to happen necessarily. It's just something that I want you guys to think about, that those relationships are pretty strong. And there's plenty of financial reasons on why those relationships exist, including if you had to borrow money to buy farmland, for instance, and you're paying 8% interest, but your rate of return's 3%. It's tough to square that circle. Even if you assume that the farmland prices are going to go up 3 or 4% per year, you still don't get to the rate of return that the interest rate you're paying on is higher actually than your rate of return. So something to think about there. All right, so we have this tool. I just wanted to highlight it. You can Google it too, but it's the NDSU crop compare tool. So I went through all those costs, and it's useful under these circumstances because you can put in your seed price. And these are just generic. These are what we put into the thing when you download the Excel spreadsheet. So this one's for the Northwest, but you just put in your own seed costs, your own herbicide, fungicides, and you can talk to Travis. And I know Travis is familiar with this. If you are having some trouble, email him. He'll hook you up, show you how to use it. But I'll just do a quick. All it's doing is saying, okay, here's the reference crop. In this case, it's spring wheat. Expected cash price, expected basis. And then what would the relative price of durum, barley, corn, soybeans, sunflowers, canola, flax, etc. have to be in order to get, and what would it turn out to be to have the same income? All right, and then you can put in the yields too. So if you're trying to sit there and decide, am I going to grow canola, or am I going to grow durum, or am I going to grow spring wheat or corn or barley or whatever, this is a good tool to put in what you think the costs are going to be, or unless you know what they are, which is even better. Plug those in and see. And what it's really is you put in a believable yield and a believable price that you expect to get, and it kind of shakes out on which one you think is going to be most likely and profitable. Okay, so some production cost comments. Production costs not likely to decline much into 2023. They are coming down some by I showed you in the tables and charts, but they're going to still be well above the 5-year averages. I mean, and that 5-year average is coming up, and part of the reason is how high they were last year. Chemical costs declining slightly. Machinery costs, especially new, likely to increase, much more likely to continue increasing, and pretty much no chance they decrease. And then seed costs increase slightly too. And then the return of interest rates being a cost factor. For the last few years, interest has been a kind of a non-factor when we're making decisions because it's been so low. But starting to get around 7.5%, all of a sudden interest becomes something we got to consider, right? In terms of the cost of borrowing. Then land values and rents. I think land values are going to increase again next year, but I don't think they're going to be as pop as much. I mean, it's hard to imagine they don't increase again because of the last year we had was pretty strong, and some of those same motivations still exist. But I don't think it'll be as high because I think a lot of folks spent up some of the cash they had the year before, so there probably won't be as many people in the market. And then the other thing, large increases in equipment costs. I mean, if you buy a whole bunch of new land, unless you were already renting it in the first place, these equipment costs and prices may give people a little bit of pause on, do I really want to farm another half or another section or something like that if I got to go out and get bigger or newer equipment to do it, with what's going on there. And I think rents are going to increase. I actually think rents are going to increase quite a bit more than they did a year ago. I think that last year's 3% or so was again due to reluctance on people wanting to renegotiate because of what production costs did, but because of how the last year turned out and we were able to navigate the higher production costs and still turn a profit, I think people are going to be less reluctant to sign into or request a higher rental agreement from tenants on average. So it's my crystal ball projection. I'm wrong from time to time, so don't set your watch by some of those projections. But that's what I see happening based on the data that's been present and sort of the trends that have occurred. So with that, I appreciate those of you who were here to listen. I'm buried in 3 feet of snow in eastern North Dakota right now and had to rake my roof for the first time. I'm originally from Nebraska. People do not own roof rakes, but it was 5 feet deep on one side of my house because the wind blew from the north, and then it made this dead zone, and it was literally like 5 feet deep. I was up there raking and shoveling. But if there's any questions, I got some time. I'd love to answer them. If you have any questions on anything, whether it's interest rates, the Fed, fertilizer prices, chemicals, machinery, equipment, and the land, I'll do the best I can to answer them.
I have a question on fertilizer. I seen on Ag News on DTN that the leading fertilizer companies, their net profit compared from 21 to 22 was 3,000%. And then there's also urea, a new production deal for urea, a plant in Washington and one down in Louisiana that's supposed to come online, and the actual cost of the urea is $275. And there's a farmer that was quoted that he was getting it laid into his farm for $400 this spring. Could you comment on that? I noticed you said you had a brother that was in the fertilizer action in Nebraska.
Yeah, what's the number?
Well, the new fertilizer production plants are going to improve the logistics of U.S. fertilizer, within the country, and do a much better job of making sure we don't have as many, because we've had in the past some regional shortages and those kind of issues. And a lot of what's going on in those areas is just making sure that you've got plants located close enough to the places where it's needed, right? So that it kind of cuts down on the logistics of shipping. The profits that fertilizer companies were making, I don't doubt it. The thing about it is, though, because of the speculative component of fertilizer, right? So, as I said, it's a globally traded commodity. So you had everyone in the world worried about being able to acquire enough fertilizer that you had people bidding up the price on the global markets, bidding it up, whether it was India, whether it was Europe, whether it was Brazil, just bidding up the price and bidding up the price because they were so worried about the conflict between Russia and Ukraine, the actions China was taking. Because most countries are not like us in the sense that pretty much all of their nitrogen fertilizers and phosphorus are made in-house. We're a little bit fortunate that that's the case for us, and that our potash supplier, the major ones, just across the border north of you guys, like 20 miles. So that's good news for us. But these other countries went out and they bid up all these products, whether it's phosphorus or anhydrous or the end result urea, etc. And so the fertilizer companies then have that incentive to charge U.S. producers what the world price is, because if you guys won't pay it, then they can sell it to Brazil or whoever else, right, for $1,200 a ton or $1,100 a ton, even though availability here wasn't an issue. And so that's what wound up happening is even though our supplies are secure, we got kind of drug into this world market bidding war for fertilizer. As far as laying it in for $400 a ton, I hadn't heard about that. Doesn't make it untrue. I just personally hadn't heard it, and I can't comment on it in the sense that it's simply because all I can go by is what the co-ops are reporting that they're actually charging